You might have seen a block of flats or property portfolio for sale in your local area, but did you know there's a legitimate way to pay even less stamp duty when you buy multiple dwellings in a single transaction? I'm a property accountant and portfolio landlord. I use this technique in my own purchases, and in this video I'll explain how stamp duty land tax works when you buy 6 or more dwellings in one purchase, using a simple case study, and why it can make a big difference to how much tax you pay. Let's start off with the legislation. This rule comes from the Finance Act 2003, section 116, subsection 7. That section defines what counts as residential property for stamp duty. And it says that whereas a single transaction includes 6 or more dwellings, it's not treated as residential and instead falls into the non-residential stamp duty land tax rules. Key word there is dwellings. A dwelling isn't a room or a tenant. For stamp duty purposes, a dwelling needs to be self-contained and capable of being lived in independently. It typically will have its own kitchen, bathroom and living space. That's why a standard shared house HMO will usually count as one dwelling, but a block of 6 flats, including studios, or 6 houses will be classed as 6 dwellings, because each unit genuinely functions as a separate home. This legislation is often confused with multiple dwellings relief, which was abolished back in June 2024. This average stamp duty, whereas this is a completely different rule. To understand why this makes such a difference, you need to look at the rates for residential and non-residential stamp duty. On residential purchases, stamp duty is charged in bands. Investors will also pay a property surcharge on top, which is why stamp duty ramps up very quickly for large properties, blocks or portfolios. By contrast, non-residential stamp duty uses a completely different set of bands, and there's no surcharge. That difference in rate structure is why the stamp duty bill can drop so sharply once a purchase is treated as non-residential. Now let's look at a case study using an example of a £500,000 6-unit block of flats. Because it's 6 self-contained dwellings bought in one single transaction, the purchase is treated as non-residential for stamp duty. Now compare that to how the same deal would look if it was taxed as residential. It's the same buildings, same buyer, completely different stamp duty outcome, purely because of how the law classifies the transaction. Important point is, don't assume this will be picked up automatically. Stamp duty land tax is usually filed by your solicitor, but many will default to residential treatment unless the issue is flagged to them. If you're buying a block or a portfolio, it's really worth getting your accountant engaged early on so that the stamp duty position is agreed before you exchange. I've actually used this in practice myself. I bought a multi-unit freehold block a few years ago, and by applying the non-residential treatment correctly, it reduced the stamp duty by just over £8,000, which resulted in about a 75% saving. At the time, it wasn't something my solicitor had dealt with regularly, so I had to walk them through the position on stamp duty to make sure it was filed correctly. That's a good example of why you shouldn't assume this will always be picked up automatically. So to summarise then, if you buy 6 or more self-contained dwellings in a single transaction, the purchase is treated as non-residential for stamp duty purchases. This can materially reduce the bill compared to residential rates. 2 things to make sure you get right though: it has to be one transactions and they have to be genuine dwellings. Finally, don't assume your solicitor will automatically apply the non-residential treatment. If you're doing a purchase like this, get your accountant involved early. If you've enjoyed this video then, you're going to love this next one, where I take you through 3 different ways where you can legitimately invest in property using excess business profits. Watch the video now.